Welcome to the Baldwin CPA's webcast, CARES Act for Employers, Understanding Employee Retention Credit. Over the past few months, we have been inundated with information, including regulatory and tax updates, as well as the CARES Act stimulus package. One aspect of the CARES Act created the Employee Retention Credit, which encourages businesses to keep employees on their payroll. The refundable credits are designed for eligible employers whose businesses have been financially impacted by COVID-19 and did not receive the Paycheck Protection Program loan. Like so many of the other programs, navigating the eligibility requirements and documentation can be challenging. Today, our presenters are Baldwin member Beth Overby, CPA, and Shannon Mattingly. They will guide you through the Employee Retention Credit, eligibility requirements, and how you can take advantage of the credit and help your business recover from the impact of COVID-19. And now I'll pass it over to them to start the presentation.
Good morning, everyone. I appreciate everyone joining us today as we dive into one section of the CARES Act. As Leslie stated, we're going to look at the Employee Retention Credit, which was under Section 2301 of the CARES Act. And so, at a basic level, the CARES Act stated the Employee Retention Credit is a fully refundable tax credit for employers equal to 50% of qualified wages paid to employees. And this will apply to wages paid after March 12th, 2020 and before January 1st, 2021. So it does give you the ability to go back to that March 12th date and capture those wages once we determine that you qualify. And there is a great way to go backwards. So just keep in mind that we can go back to March 12th. The maximum qualified wages total $10,000 paid to each employee for a maximum credit of $5,000 per employee. So as you can see, that can be pretty valuable at $5,000 per employee, and that's a credit. So that would be dollar for dollar benefit that could affect your, could really benefit your cash flow immediately. So who qualifies? The IRS has said that any employer carrying on a trade or business during the calendar year 2020, including tax-exempt organizations. And I think that's going to be important to keep that in mind. If you are on the board or a treasurer or involved in a tax-exempt organization, they do qualify for this. And I know many that I've heard from have been hit pretty hard during this time period. So keep in mind and make sure you spread the word to any of those organizations that you're involved in. So any employer that carried on a trade or business that was full, and so this is an either or, so you only have to meet one of these. Fully or partially suspended operations during any calendar quarter in 2020 due to COVID, or experience a significant decline in gross receipts during the calendar year. And keep in mind, we're March 12th through the end of 2020. So even if you may not qualify now, as we all know, it's very hard to predict what tomorrow or next month or 3 months from now will be like. Keep in mind, it may be something that you could utilize on down the road later this year. And the nice thing is too, all sizes of employers are eligible. So again, this is an either or, so we can either qualify as fully or partially suspended or the gross receipts. So there are a few exceptions on who qualifies. Government employers are not eligible. Household employers are not eligible. And this would include a household employee. A good example would be a nanny. So if you have hired a nanny, unfortunately, they do not qualify. Self-employed individuals, so sole proprietors, your single member LLCs, they're not eligible for their own earnings, but may be able to claim the credit for wages of their employees. So keep in mind that if you're a sole proprietor or an LLC, all on just a simple Schedule C, you could still qualify if you have employees. Also remember that if you receive the Paycheck Protection Loan, you do not qualify. Now, they did clarify that if you received the PPP, but repaid it in full within that grace period, you can qualify for this credit. So keep that in mind. I know we had several clients that with the uncertainty of the rules at the time was just a little unsure, so they repaid the PPP. So this would be a really good alternative for them, is to claim this credit. So let's dive a little deeper into the two items to qualify. The first one, significant decline in gross receipts. So basically the credit says, look at the first quarter in 2020 for which your gross receipts are less than 50% of your gross receipts from the same quarter in 2019. So for example, run in your accounting software, use QuickBooks, or run an income statement, second quarter 2020 compared to second quarter 2019. If your gross receipts are down by 50%, you would qualify. Now, interesting is that the CARES Act does not require that decline to be specifically related to COVID. So keep in mind, as long as there is a decline, doesn't really matter why there is a decline, just that there is one. And the IRS has said that you would need to keep record of the relevant quarters for at least 4 years. So we would want to keep all your documentation, any reports, any bank statements, which honestly, most clients are keeping this information anyway. So that's really not any additional burden. So how to define gross receipts? For your business, total gross receipts would be your total sales, net of any returns or allowances, and all amounts received for services. So basically, very simple definition, total sales, net of returns, and then any sales or income from services. It does include investment income, such as interest and dividends, and they do not require you to subtract cost of goods sold. For any manufacturing company, do not subtract your cost of goods sold. So they really are looking at that top line number. For nonprofits, your gross receipts are defined as all operations, so income from all operations, including investment income and contributions. So again, the gross receipts is a pretty easy definition, just your top line sales, net of any returns or for services. And you can include investment income. Now, if you did start your business in 2019, you use whatever quarter you started in as your base. So for example, if you started the business in second quarter 2019, then that becomes your base comparison for first and second quarter of 2020. Same idea as if you started it in third quarter, that is your base to compare 2020 first, second, and third. If you acquired the business, so if you purchased the business in 2020, they actually have given some good guidance about looking back to the company that you acquired it from as a base. So if you fall into one of those categories, please reach out and we will help you go through that detail, because they really are giving you some like a safe harbor, some flexibility on what your comparison is. Then you continue to be eligible for the credit until your gross receipts are back to at least 80% of prior year. So again, run that report in the accounting software, see where you are quarter over quarter, first, second, etc. And then if you're within that 50% decline, you would be eligible. And then once your gross receipts come back to at least 80%, that's when the credit would stop. Now, I think the fully and partially, as you'll see, this one becomes a little bit more challenging to qualify for. And so what it says is that fully or partially suspended due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID. So they define a government order, from, for example, an order from the city's mayor stating that all non-essential businesses must close for a specific period, a shelter-in-place order, or an order imposing a curfew that impacts your operating hours. So I'd keep in mind that the order must be from an appropriate government authority, and that's going to be key with all the news, all the press conferences, all the information that's flowing to us 24 hours a day, that it must be from a government authority, a signed order, and not, that's what's going to be key, is to make sure that it is an official order from a government authority. So a few items. So a statement at a press conference by a government official does not rise to a government order. And I think we hear a lot about, best practice. We got to be careful on not assuming a statement at a press conference for a best practice actually gives rise to a government order. Also, an employer that voluntarily suspends operations that is not subject to any government order is not eligible. So an employer that voluntarily suspends would not be eligible under this item. Now keep in mind, you could still qualify under the gross receipts. So that item is specifically if you're trying to qualify under fully or partially suspended. So an employer that operates an essential business that is not considered to have a full or partial suspension if government order allows the employer to stay open. A good example that the IRS gave in their information would be, for example, a grocery store. So as we know, the grocery stores were considered essential, but many of them limited their hours and their days or their time that certain people could shop. Because they were considered an essential business and the government did not put in those requirements, they would not qualify under this example. And then here's a tricky one. So if the employer's workplace is closed by a government order, but the employer is able to continue comparable operations by requiring employees to telework, the employer is not considered to have been fully or partially suspended. So this is kind of bad news for those employers that were able to get their employees working from home. One example the IRS had on their website or on their information was a software company. in which the employees would kind of go back and forth with working from home and working in the office. And so when the mandatory work from home order came down and they could not go into the office, client meetings were limited, they could basically still do everything they were doing, but could do it from home. They are not considered to have been fully or partially suspended. So that is definitely one thing to watch for our service businesses, that we're able to transition a lot of our employees to home. Even though our offices may have been closed, if those employers or employees were able to work from home and your operations were able to continue fairly close to normal, you would not qualify under the fully or partially suspended. Again, you might still be able to get it under that gross receipts test. So that's why we got to look at both. One thing that they have clarified, and I think this is going to be important, is as the shutdown orders are lifted and we're able to start getting back to business with a certain percentage of operations or a percentage of capacity, we can use either or of our 50% of gross receipts or fully or partially suspended at different times of the year. So the employer could qualify for March, April, and May under the fully or partially suspended. And now as the shutdown orders are lifted, that may no longer apply, but they may be able to qualify under the gross receipts test. So that, I think, is going to be important to keep in mind, that as some of these partially and fully suspended orders are starting to loosen up, we should look at that gross receipts test later in the year. Because I think it's fair to say that certain industries, even at a certain percentage of capacity, may not get back to their gross receipts of prior year. Restaurants come to mind, again, nonprofits come to mind. So we could use both of these at different times. So now let's look at what really comes into the definition of qualified wages. Now that we know you've qualified either under one of our two tests, what is included in wages? And there is one change in the definition if whether you had over 100 employees or under. So if you had over 100 employees, the qualified wages only include the wages paid to employees when they are not providing services due to being suspended operations or the decline. So if you're over 100, you're going to be fairly limited on the wages that will qualify. Now, the good news is, for anyone that has less than 100 employees, qualified wages equal wages paid to any employee during any period of economic hardship. So any wages paid during when you might qualify for the suspension or the decline in gross receipts. So the definition of wages are going to be for, Social Security taxes, plus, and we'll touch base on this on the next slide too, is the health plan expenses, both, the employer portion of the health insurance. Now, one thing to be careful about is the wages that would be paid or qualified under the Families First Coronavirus Response Act, that's a mouthful, that you paid for the mandated sick pay or child care leave or the extended Family Medical Leave Act. Those wages do not are not included for this credit. So we can't double dip, basically. So if you got the credit for that sick pay or the extended FLMA, then you can't take it on the retention credit. Qualified wages, like I said, do include your health plan expenses. It is also interesting to note that if you had someone laid off or furloughed and you continued to pay their health insurance while they were off, that does count as qualified wages. So it would be their wages paid plus the health plan expenses. Now do keep in mind that wages paid to related individuals are not taken into account for purposes of the credit. And this would include a child, brother, sister, father, mother, step, everything basically. But it specifically doesn't include the spouse in this list of exceptions. So as an employer, if you paid your spouse for working in the business, which many small businesses do, they would count. So you could include their wages, just not a child or close relative like in our list here. So keep that in mind. Spouses are included. Basically, other families are not. Family members are not. So now that we know how you qualify, what's the wages, how do you actually get the credit? So the credit is allowed against the employer's share of Social Security tax. So you first get to reduce your employer's share of Social Security and or Social Security tax. If the credit exceeds that employer's share of Social Security tax, the excess is treated as an overpayment and then can offset any remaining tax on your 941. And then any remaining and additional can be refunded. So basically it's just a way to step down on what you can offset. So you start with Social Security and tax, Social Security tax, employer, take that down to 0. Then you can offset your remaining 941 liability. And that would include the employer share of Medicare, employee and employer share, or your employee share of Social Security and Medicare, plus their federal withholding. So you really get your 941 down to 0. And then any remaining is refunded. Now, obviously, depending on how often you do your payroll tax deposit, there might be a gap from a timing standpoint, or you might qualify to go back and capture some wages that you've already paid in your employment tax on. And in this situation, the IRS has created Form 7200 for an advance payment. They're really trying to get this money back into the small business hands as quickly as possible. So Form 7200 was created for taxpayers and employers to complete, fax that in to the IRS, and be able to get the money back quicker. So we put a screenshot of the 7200 form, and really it's pretty basic. The first top third of the form is basically your demographics. And then in part 1, you just mark what type of employer filing requirements you have. And then in part 3, you basically list the credit that you've calculated, sign and date, and fax away. And then what will happen is you will then reconcile any advance payment when you file your 941 form. This form can be filed multiple times during a quarter. And again, what it's doing is it's trying to get that money back to you, as quickly as possible. And you can file it at any time before the end of the month following the quarter in which you paid the qualified wages, which I know is a little hard to follow, but basically, so for example, if you paid the wages in June, they're saying you need to file it before the end of July so that way you can reconcile it with your 941. So again, you can either take the credit, you can first reduce your payroll tax deposits, and then whatever's left, you can get back as an advance. And the 7,200, if we're trying to go back and capture some from March 12th forward, first and second quarter credit would need to be filed on the 7,200 form before July 31st. So we created a Excel template worksheet that I'll share my screen just to help clients and employers track the date the wages were paid and then how much is your remaining balance. So let me share that Excel spreadsheet. And I am going to turn it over to Shannon and let her dive into a little more detail on how this is calculated.
Okay, hi, thank you, Beth. So we created this Excel spreadsheet in order to track, make sure that you're averaging out your 50% credit, make sure that you are staying within the $10,000 worth of qualified wages per employee. So like Beth mentioned, you would just fill this out each time that you had payroll. The spreadsheet is designed with formulas and everything to calculate all of it for you. Employer paid health insurance goes here because it does qualify as part of your qualified wages. It's going to calculate what your 50% average is. And then it's also going to track and let you know once you've hit that $10,000 worth of qualified wages so that you don't go over and try to take any credit above and beyond that, accidentally. Because when you have so much going on, having to go back every payroll and say, okay, how much did I pay last time? How much did I pay last time? How much can I take this time? So this is a really quick way to see all of that on one screen. Your 50% average wages column, that number on each row is going to be what your credit is for that employee. You would just total that up for each employee, and that's going to be your credit that you'll use toward your employer's Social Security credit. And again, like Beth was saying, you'll apply that to your 941 deposit. Depending on what your filing frequency is. So if you are a weekly, a semi-weekly, or a monthly depositor, you can reduce the amount of your 941 deposit based off of these credits. Now, if you are a quarterly filer, and of course we've got some little notes up here for you to even follow as well. So if you are a quarterly filer, you would incorporate this credit on your 941 that will be filed at the end of each quarter. The 941 deposits, again, you can claim these as you go and retain that money as you're going through. And then when it comes time to file your quarterly 941 form, you would show that credit on the form. And they are releasing an updated 941 form that you will use. One thing that I would like to mention about that is coming out is that these credits, you can begin to use them as of March the 13th. That, of course, falls into first quarter payroll tax returns. They are requiring that you include any credit that you utilized during that time in the first quarter with your second quarter 941. And there will be an adjusted form where you can capture all that. Also, like Beth mentioned before as well, we can go backwards. So by submitting the Form 7200, you are able to go backwards and capture that credit for payrolls that have already been done. And this Excel spreadsheet is a really good way to kind of fill that in and say, okay, how should I fill out the 7200 form? What were my totals? What were, my qualifying wages? What was my 50% of that? What's my credit? Up to the $10,000. So you can go backwards and claim all that. And so, like I said, this is just a really good way to track that if you don't have a system in place already.
Great, thank you, Shannon. I also want to point out that the spreadsheet, we've left plenty of room for multiple employees. Plus, it gives you the totals down here at the bottom. And I thought the totals were really helpful recently when I was doing the 7200 form. So I think the spreadsheet's nice, it's simple, but yet the key is going to be keeping track of how much wages left, how much wages are left before you max out the credit. When one thing, we received notification from earlier this week that if you process payroll with AP, tax is not the next step to allow the others so 700 form Shannon, if you can talk, it looks like I'm having audio problems. Maybe you can take over.
Okay. Let's see. I believe you have control of the screen still, so if you want to flip to the next one. Okay, so okay, let's see if we can get to the next slide as well. Okay, so based off of what Beth has gone over so far, we did find this really nice flow chart. Flowcharts seem to be very helpful. It does allow you to kind of clarify which direction that you need to go in to see if you qualify for the retention credits. So basically, it's saying, hey, the credit is given to including tax exempt organizations, anyone who's in business. So then, of course, you would just follow that flow down. Eligible employers must fall into one of the two categories. Which one do you fall into? Did you have fewer than 100 employees? Did you have more than 100 employees? So this is just a really nice flow chart to kind of help you decide, okay, where do I fall into this? And as you figure out where you fall into it, then you can dive a little deeper into those requirements to see if you meet those underneath of the IRS rules. Next slide, please. Also, as Beth mentioned as well, there are several different types of credits. One of the things she mentioned is that if the COVID-related wages are not qualified wages to receive the retention credit against. So this is a list of those. If you did pay out COVID quarantine wages to employees, then those do not count as part of your retention credits that you may qualify for. They cannot be included in there. Now, we did put out a list of kind of how those credits work for that, just to kind of, you know, briefly show you what those look like. But as of today, we're really kind of focusing on the retention credit specifically. But we did want to put this out there. So the paid sick leave credit and paid family leave credits are available for eligible employers who pay qualified sick leave wages, and you know, that qualify from 4/1/2020 through 12/31/2020, and who have fewer than 500 employees. There are dollar and hour limits that are attached to these for those particular COVID-related credits. So again, this is just one that we kind of wanted to touch base on, let you know that that is out there. However, these particular ones do not qualify for the retention credit that you may have. So you can't include those wages. I guess, next slide. Okay, so we will be answering any questions that you all may have. A recording of this will be posted on our website, and we will also have a copy of that Excel spreadsheet posted on the website as well that you all are welcome to utilize. Additional resources are out there. You know, if you all have any questions, we'll try to answer just a few of those if you have them at this time. I believe, let's see.
Shannon, can you hear me now?
Oh, yeah. Yeah, there you are.
Better? Okay, great. Thank you so much, Shannon. That was perfect. I did want to add, when my microphone was acting up, felt like I could be a YouTube video at that point, making fun of all the issues with our video technology.
Yeah.
But the one point, I saw an email this week from ADP, and ADP is only set up to allow the credit against employer, Social Security employer taxes. It's not set up to allow the credit against the other federal taxes or refundable. So definitely keep that in mind if you are processing payroll with ADP. I would hope they would be able to, you know, update their system soon. So we might want to think about the 7200 form as an option to really be able to benefit from that credit.
Beth, it looks like we just have one question here that someone asked. They said, our decline began at the very end of the first quarter and continued through the second quarter. So can they use the same measurement using the second quarter? They said it only makes sense because COVID didn't really hit until late March, the very end of the first quarter.
Right, that's great. And so you got a couple of things playing into there, that the decline, keep in mind the decline does not have to be related to COVID, even though a lot of businesses and industries were coming off a great year, and they did see more of that decline in the second quarter. So that second quarter would be your base. of comparison for qualifying under that gross receipts calculation. I know locally some of our stay-at-home and executive orders were coming in, that middle of March to 1st of April. So once you have that decline, that's the first quarter that you can be eligible for. So in that situation, you would use those second quarter wages.
Well, if anybody has any other questions, you can email, I think the next slide, if you have Shannon and Beth's information, you can either email them or email marketing@baldwincpas.com as well, and we will include it in the question and answer that we'll be posting to our website if you have any other things that you need clarification on. But as for that, thank you for everyone for attending today. We'll get everything on our website as soon as possible so that you can use the Excel spreadsheet, get these slides, and get the recording of the webinar. Thank you everyone for attending and have a great day.
Thank you.